Hello and welcome to the show with me, Jillian Godsil. And today my guests are Marc Meyer and James Kouzinas, if I'm saying that correctly, and who are both working. One is both directors, and one is James, co-founder of Crowdz platform. So thank you very much for coming on the show. And before we jump into Crowdz, which is fascinating, can we have a little bit of your background? So I don't know who wants to go first. Marc, your mic is still open, so we start with you. Tell me a bit about your background, how you got into the crypto rabbit hole, and how you linked up with James.
So basically my background is in financial services, more specifically into payments. I worked in payments company, Barclaycard, ACI, and I ended up working at Crowdz because I knew the founder and they needed a payments person, and little by little the vision was always to move everything onto the blockchain. And we'll probably come back to this later on. And this is where basically I met James and we wrote the white paper for the company. And basically we are now full onto making our business Crowdz onto the blockchain.
Okay. And James, is your background also finance, or is it tech?
Yeah, it is. It's mostly in banking and financial services. So I spent roughly 11, nearly 12 years with National Australia Bank, one of Australia's big business and institutional banks. The majority of that time was spent on a foreign exchange desk, looking after corporate and business clients, helping them with FX risk management. When I finished up at the bank, I actually jumped out, and because I was getting very heavily involved in crypto and blockchain and just technology more specifically. So I was just really enjoying the crypto ecosystem. That was 2017, 2018. And you would know.
You enjoying it there? It was a bit crazy, though, wasn't it?
2017 was fun. 2018, maybe not so much. But when times are tough, you see a lot of innovation come to light. And I think that was really the birth of DeFi and some of the really awesome applications we've seen, like Compound and Aave and stuff, kind of be born in that time. And then, I actually found Crowdz. I found Crowdz through I was actually working at a venture capital firm in Australia. We'd come to America looking for investment opportunities. We'd met Crowdz through Techstars. There was a bit of a platform there. So we'd met the founders and got involved. And it's just been really cool to see the company grow. And when I joined, I got to work really closely with Marc and some of the other team members on really bringing the Web3 vision of Crowdz to life. And we've got a really strong thesis on how Web3 and blockchain is applicable to finance, specifically invoice finance. So we're working together to bring that to life.
Because invoice financing, I was told before a long time ago that it's one of the most antiquated systems in the world. It's like couriers bring pieces of paper. People sign stuff and they courier to another location. So it's incredibly slow and illiquid, and it's controlled, and the payoffs are huge by the middlemen. So it's an industry ripe for revolution and for changing disruption. So with Crowdz, which came first, the whole invoice financing, the supply chain area, or the actual marketplace itself? Did they come together or?
So the market, everything started with the marketplace. So we have an up and running marketplace, but I would say it's more a traditional approach to a marketplace. Is already an improvement because we digitize everything, and we digitize the trade and straight through process. But the next stage is really to move, and I think that's why it's becoming, we're going to leverage the power of the blockchain, is we're going to move all the information, so i.e. the invoices onto the blockchain, allowing frictionless transactions, reducing fraud, and reducing the time of the transaction as well, basically. But so the market came first.
Okay, does Crowdz go after the opportunities, and then is it like you have an industry ripe for disruption, then you go after the audience, and then but you also have the technology. So it's putting everything together. Is that how it's working?
Yeah, exactly right. So we have and I'll break it up into a few different parts. We have a core marketplace, or what we call the core marketplace, and that really is there to connect SMEs who are seeking financing with funders who wish to participate in the asset class by buying those receivables that are up for sale. And that's a really direct-to-business model. It's out there. Anyone can sign up and onboard, and we have a automated vetting process that determines the creditworthiness of these SMEs, etc. But we also thought it'd be really neat to offer this technology as like a white label to financial institutions.
Oh.
Many financial institutions across the world have done a great job at amassing customer bases and developing trust with their customers. It's not always the case, but in a lot of cases, a lot of people still trust their bank, but they are running on really old school technology. They hadn't had the opportunity or the flexibility to update their technology stacks. So we thought that's a really good opportunity to not really go out there and disrupt banks, but rather enable them to better serve their customer base. So we work with a number of banks that can leverage our platform to better serve their customers so they can take advantage of our technology and our innovation. So that's really been the business model today. And when you dive into that, what does that mean? There's all sorts of interesting little things we're developing. Algorithmic credit scoring system, automation.
I was going to ask, can I just stop you there?
Yeah.
So when you said it's all done automatically, the vetting, that's kind of important, isn't it? I mean, how do you, presumably you got a complicated algorithm or AI system going through lots of things, because you don't want to bring in any bad actors onto the platform.
Yeah, I'll let Mark talk about the surf score, and I'll cover just the first part of it, the onboarding, which is really automated KYC, KYB. And obviously we were chatting before this, we started recording, and, Mark and I are very strong advocates of decentralized finance in a total view where it's permissionless networks and open access. When you're working with institutions, you can't go too far down that side of things. You still do need to KYC, KYB people. And this is where we feel Crowdz is really merging the existing world with Web3 and creating that kind of bridge. So we do KYC, KYB of funders and invoices, sellers who are looking to sell their receivables. And then that moves into a really interesting surf score, which is our credit underwriting algorithm. I'll let Mark talk about that. He's doing a lot of work on that.
Yeah, so the idea is basically, so the two phases of the credit risk. It's basically when you onboard someone, you don't know much about this company itself. So we pull data from different places. Could be credit bureaus, public available information, as well as the accounting information, basically. And we also ask them to connect the bank accounts. So basically we have all of these data points that allows us to make a decision on the risk this particular customer brings, but also the relationship between a supplier and a buyer. So we also can risk this relationship, which is the most important one. And as someone trade on the platform, we start having our own data, which actually feed into the model that allows us to better predict the risk an investor takes whenever they invest into an invoice, basically. And basically it's backed by machine learning, and basically we have people modeling the different type of risks.
Brilliant. And then do you, when you bring on board the SME and they want to look for the investors, you break it up. It's not just, so you tokenize the invoices, is that correct?
So yeah, so that's at the moment we're not doing it. We are actually on the let's say prototyping, but it's exactly what we're doing. So where we had to be, and maybe where we are different, and where we're trying to be very careful. One thing is we do not put public, I would say, information onto the chain. So everything that is really confidential to you, it remains into a private database. And the reason why is, in Europe, you have GDPR rules that are very stringent. In Australia, where we're starting a new white label, is also very stringent. US is a bit more liberal about that, but the point is we cannot put whatever we want onto the chain. That's a no-go. So everything we put on the chain is the invoice, but the information that allows you to make investment decision. So that's what we do. We tokenize the important information that helps you to make investments. The second thing is, at this stage, we don't fragment the invoices either, because as soon as you start fragmenting, so they're all non-fungible tokens. Because as soon as you start fragmenting invoices and potentially make them fungible, you enter the world of securities and all the implications that goes along with that. So it is on the roadmap. I think we're going to talk about the roadmap, but at this stage, we don't make these invoices fungible, if that makes sense.
So you have a single invoice, but would you have multiple investors?
Multiple investors, multiple invoices.
I missed that, I beg your pardon.
It's many to many, multiple investors and multiple invoices and obviously sellers.
Okay. And then you mentioned NFTs. Can you talk to me about the role that they play in the platform?
Yeah, Mark, I can take that at the start. So what Avalon Marketplace is doing essentially is taking a receivable, think of it as a PDF, but what we're doing is we're tokenizing that and turning that into an NFT, a non-fungible token, and placing certain bits of data pertaining to that NFT or that invoice rather on chain. We're actually working with Polygon and doing everything through the Polygon network. They've been in the news a lot in the last 12 months. I've done a tremendous job penetrating the institutions of the world. I think Nike just announced a deal with them, which is really cool to see. When it goes on chain, like something really cool happens in that it standardizes the data. And when you look at different banks around the world and different funds who are kind of trading this asset class, none of the data on a receivable is standardized. And that makes it really tricky to work with. A lot of these banks don't just do invoice financing at the basic level. They actually do securitization and syndication. And as you said, before you talked about antiquated systems in finance, and that's a really antiquated system. It's big business in banks, but lots of middlemen are needed to actually make that happen. But
so are you comparing apples with oranges? That's why I guess
exactly right. And also in traditional databases and finance, there's very little to no composability because everything's built differently. A lot of the groups haven't built their own API endpoints. Nothing can kind of talk to each other. So you've got to have people in the middle to facilitate that side of business. So when we're turning into an invoice, it's being placed on chain and it facilitates a lot of that stuff, which we can dive into. But at the basic level as well, it becomes easily viewable by funders and other parties should they want to view that. And then lastly, it becomes very easily shareable. So we've been doing some demos and prototyping, and we're showing how easily it is to write into the smart contract and just the code that once it's minted, it can immediately be made available on OpenSea, as an example. Now, our version of that will be working with kind of regulated marketplaces. So in our world, it's like Goldfinch Crypto. It is Centrifuge have built a marketplace for real world assets called Tin Lake. It will be automatically sharing potentially our receivables with those marketplaces, all coded. It's just as soon as it's minted, it can be made available there in pools, which is really cool. So that also opens it up to be able to be settled with stablecoin. Right now, everything transacts on traditional payment rails. When you go cross-border, that becomes problematic because cross-border transactions are mostly conducted by SWIFT. And SWIFT was formed in 1970s, I believe.
So it's ancient.
It's ancient. And SWIFT will come to market and say, we've developed other big solutions around leveraging a blockchain. And they have indeed, but the minimum requirements to get involved in that are very expensive. And there's minimum face values. Whereas we're saying, hey, once you tokenize, you can settle this invoice with Polygon. You can use a stable coin like USDC, and actually to transact on Polygon costs under a cent and happens in under a minute. And there's full transparency as to where the transaction's taken place, at what time it's taken place, and between whom. That's quite powerful when you have a finance transaction with multiple parties involved. In our view, that's really cool. So
it's true, because I know people who are not familiar with the crypto industry in general say, oh, it takes so long and you can't do any transactions per second, whatever. But I know a friend of mine personally, her mother had a house in Mexico. The absolute kerfuffle trying to sell and then repatriate the money back to Ireland. It just took so long because of all the different systems and obviously there was legal stuff, but actually the transfer of money took weeks and weeks and weeks. And kept on bouncing back and being rejected. So, so it's no good if you can do multiple transactions per second if you can't get it into your bank account or whatever you want with it.
Exactly. And that's a great example. You've got an exotic currency and you're trying to convert that to a major currency. Which banks are going to do that? When it's going international, it's going through several parties. It's going through several intermediary banks and they're all taking their fee. And when that money goes, there is no transparency as to where it is. It's just in limbo, right? It's kind of crazy. Yes, there are solutions that are being built by banks and they're forming their own networks, and domestically they're doing this in Australia, in the UK, etc. But still, there's limitations on how much you can transfer. So when you look at the world of business, 10,000 minimum doesn't work. 100,000 doesn't work as a minimum. You need unlimited upside in the value. So with Polygon, as an example, you can remit $2 million cross border in under a minute. So,
and I guess this probably excites you a lot, Mark, because you said you come from a payments background. So what are you enjoying innovating here, or what about the platform really makes you excited about the future of payments?
I think might be a bit boring, but what excites me a bit more is the visibility. So today, for example, when you get paid onto your bank accounts, well, you're based in Ireland, right? So we are into the open banking world, so we can have some information from the bank accounts, when the money hits the bank account. That's feasible, but it's not perfect. The system is closed. So basically, when for example, I would pay James for a job he did for me a few months back, I pay him on his bank accounts. It's difficult to reconcile, automatically. I don't know exactly when the money hits the accounts, and I think that's some of the limitations you have on the payments. Whereas here, if I pay it to a smart contract, I know that the payment has been done. I know I have visibility. The reconciliation becomes easier. You cannot really fraud the system here and say, "Oh, you never paid me." Actually, this is pretty transparent to everybody. So there is this aspect about payments, because I'm a bit more usually, when you look at innovation in terms of the payments piece, you have faster payments in the UK, SEPA in Europe. So there have been some innovations in this particular space, but the fact that it's still kind of a closed system, and you don't have these webhooks to tell you that you've been paid, limit innovation basically, and limit transparency and reconciliation and increase frauds and so on and so forth. So that's probably the most interesting piece. On the cross-border payments, Swift GPI has been improving. It's still pretty expensive, but to James' point, he's right in terms of we can potentially leverage cross-border remittance payments via cryptocurrency. The thing is, you still have the questions about how do you, if you pay the wrong address, what happens in terms of refund, and so there's still some business processes that needs to be implemented into that. But
isn't that a question of creating a better UI UX? Because that's why we mentioned earlier, before we started recording here now, about the failure of centralized systems. And like Celsius, for example, was very easy to use. A child could use Celsius. It felt natural. And then you go back to, say, proper DeFi or anything else, and you're moving stuff around. It is more complex. So I think the onus is on the builders in this space is to make something that's still decentralized, but easier to use. So does your system also increase, presumably, liquidity in the payments? That helps. Are the payments, do the SMEs pay less for are there discounts? Who benefits in that way? Do the SMEs pay less and do the investors get more, or how does that work?
Yeah. Do you want me to take this one?
I can take it. It's a really good question. Our general view is that when you've got an antiquated financial system, that cost has to be passed down somewhere, because the fact that it's antiquated, it needs more people in the middle to make a transaction happen. So now when you go, okay, let's eradicate some of those middlemen, let's get them out of the picture, and let's go more peer-to-peer and clean up the systems. In theory, that should be that those benefits are passed into SMEs seeking finance, and they're passed into funders who are actually seeking to put their capital to work. The thing is, though, we've actually built a marketplace, so there's a bit of free market forces that apply here. So you never really know for sure which way it's going to go in terms of, is that pricing going to be passed on? Really, the interest rates, though, are driven by things outside of what we're talking about. They're driven by what's happening in the macro, in the macro sense. So really, I think that's where it comes down to. But what we can ensure we control is the efficiency and the time. So if you take one cross-border transaction as a great example and say to a funder, or say to an SME, hey, go to a fund and get financing through a different invoice finance fund, they'll need to provide a truckload of manual information like PDFs and statements and what have you. They'll then probably, wait 4 or 5 days for the credit paper from the fund to be done and approved. Then they'll get their limit established. Then they'll be receiving their funding. Now, if that funding's done cross-border, add another 2 to 3 days in for the settlement. You look at that and you go, wow, that's a big process. It's like maybe 7 to 8 days it's taken them. And that's being very conservative as well. We know it takes longer, and they've given up a truckload of their time getting it done. The Avalon Marketplace is seeking to eradicate a lot of that time and say, hey, come in on board. We've already automated KYC, KYB checks. We've already automated a large part of the credit underwriting because we're tapping directly into your accounting software and your bank account, and we're running the data through our algorithms so we can get that credit scoring done. And then you can immediately access your financing on the platform. Let's say it takes 48 hours in total for everything to come out. And because we're financing you, if they do want to be financed in stablecoin, let's pretend they do, that's instantaneous. That instantly hits their wallet, and then they can convert via a fiat off-ramp into their native currency, which that can take a day depending which country they're in. So suddenly you've gone from 3 days, that's 3 days of financing for cross-border compared to 7 to 8. Yeah. So that time is huge. And then when you put a cost of capital against that time and average that out over how many times they would transact, it adds up.
So where are you getting because you're looking for both investors and SMEs. You're matching them on the Avalon platform, and presumably you're also looking for banks to white label the product as well. So that's obviously more a B2B conversation, but in onboarding your SMEs and investors, how are you doing that?
So on the SME side is pretty straightforward. You get to the platform, you register. It's pretty much automatic, except with the exceptions like customers who don't pass the KYB or KYC, and potentially sometimes we have to do some manual checks. But that's pretty straightforward. On the funder side, so at this moment of time is more conversation to have, and this is where James is heavily involved to onboard some funders, because we're not talking about the retail market here as a term of investors. They all have their requirements. They all want to know a bit more about the business, and it's a bit more manual. In the future, though, we would like to have, once we have more and more volume and let's say brand equity on the market, is to get automatic onboarding, so self-servicing basically. But I think I usually, when I compare our business, I think it's more like the money market business, where basically you have like potentially big investors buying bonds, or it's usually more more institutional investors. No,
you're not looking to crowdfund lots of retail.
No, the reason why, twofold. At the moment, we don't fragment the invoices, and they could be quite big. So I personally won't buy one invoice at 10,000 grand, basically. That's not going to happen. Too much risks. So you have to bring a lot of capital. But the second reason is regulation. Because once you tackle the retail markets, again, you are potentially selling, securities. Particularly if we start also fragmenting, and if you have securities, you have to create a prospectus, country by country. It's a lot of work, and maybe I don't say like 2 or 3 years down the road we won't do it. But at the moment of time, it's more like, I would say, the money market with institutional investors.
Okay. I was reading through, I think it was the white paper, and there was a reference to CBDCs, and they said, prepare Crowdz for future of money. So how important, CBDCs have sort of like a bit of a poison chalice feeling to them. What's involved here, or what's your thinking about them?
Yeah, the market.
No, I probably have a different view, because we were discussing on this on Slack. We have different views on that. I'll let James to go first, and probably will contradict him.
Well, lively debate. Okay.
No, we're in agreement on a lot of things. I guess you can't with a great statement there, poison chalice. It's very true, because the whole point of cryptocurrencies is to democratize finance and make it open access and seamless. Now, when there's a central bank digital currency, it extends their powers, making it very easy for them to do certain things with money. So I'm very nervous about where that could lead to. But I'll keep my comments there. I'm a very strong DeFi advocate. I love decentralized finance. I love code and smart contracts. I think we should, place more of an importance on that. Humans are fallible, so we should trust code more. And of course, humans write the code. But once things are checked and they're clean, they can be, that can be posted on GitHub for everyone to see. It can be scrutinized, But putting that aside, where it's relevant to us is in a blockchain friendly world where people are actually, transacting in stable coins, whether it's a USDC or whether it's a central bank digital currency. If the general public gets comfortable with stable coins because they're coming from a central bank, that means all invoices won't be traded in fiat. They'll be traded on payment rails that are leveraging a blockchain as a backend. So whether it's a Polygon, Ethereum, whatever it is. So that means that instead of us having to convert back to fiat with payment rails like fiat on-ramp, off-ramps, you've just got people keeping their money in ERC20 tokens, which are central bank digital currencies. They're probably going to use ERC20 standard, and people just transacting on those rails indefinitely, which means very fast, very cheap, and subject to what the central bank will open up. They'll probably keep it closed loop, but you'd argue that it'd be good for them to keep it open viewing. You can view all the things that are happening.
It's to bring in the technical advantages.
I think so.
Hoping to work with good actors. And Mark, is that something that you'd agree with?
Yeah, there are anarchists like James who wants to be, to be everything decentralized. I think the learnings from the last years and all the crises, central banks are so important to manage, to manage our inflation at the moment, to be honest, to provide liquidity when there is a massive crisis. They turned out to be so important and can react quite quickly in crisis. I mean, they've not been that bad over the last years. So I don't think I would undermine them. If you have the if they start issuing their own coin, then it will be ubiquitous. This is where blockchain will become very powerful, because eventually, if you really want to have a stable coins, you probably need to have coins issued by the central banks, and will create efficiencies at all levels. So I think that's why they're so important, because they bring a scale that no one can bring. You take USDC, we both really like them because they're really backed by, real assets, real currencies. And basically, again, you have to back by, issued currencies from the central bank. That's why they're so safe. When you have an algorithm, someone believes they're smarter than anyone else with an algorithm. This is why becoming a bit more suspicious, because everybody who tried to prove that is smarter than anyone else ended up with crisis, bankruptcy, not only in crypto. I mean, I can look at the CDOs in 2008. It's just like, let's try to do something complex. And eventually it never really worked out. So I take the point that it could be slow, not necessarily the most tech savvy, but there's still the reference onto the financial industry and how we issue money, basically.
Okay, interesting. Yes, I'm good to get two different perspectives there. I mean, meeting in the middle, I know, but interesting. So, and then tell me about your roadmap, where you are and what you're doing, where you're going.
That's your one, Mark.
Well, this is you're speaking with customers, but I think from a product standpoint, so we starting, I would say simple, which is combining, so tokenizing the invoices and being able to pay them either via stable coins or fiat. And what we're doing in the background as well is actually we're measuring, because at the moment, I'm very number driven. Everybody says like, it creates efficiencies. This is really nice. We're creating a new world, blah, 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 blah. If I don't see it, I don't trust it. So what we're trying to do is to measure the efficiencies behind, just to prove to the market that there is something, there is something tangible, as opposed to like just a nice idea created by anarchists like James. But
we all need anarchists.
But this is what we're going to publish. We're going to try to publish, figures, numbers to share with customers as well. Then the second piece is creating on-ramp, off-ramp solutions, because we acknowledge that not all, let's say, a small business at the moment, if you tell the business that we're going to pay them with crypto, they probably won't accept any crypto. So we will have the options. Your investors, you want to use only stable coins, but the crypto part doesn't want stable coins. We will have enough on-ramp solutions. But down the road, and that's where it becomes a bit trickier to tell you a timeline, but we're going to issue a DAO token that has the ability to collateralize your debts as well. And eventually, we want to try liquidity pools, but it's not the technology that is complicated. Here, it's the regulation.
Okay.
Because as I mentioned earlier, is really we're taking countries one by one. So we've done legal assessment in Australia, US, Switzerland, where I'm based, UK, some countries in Europe. We're actually now digging into Italy, where we have like customers that are interested. But that would be that's where it becomes very tricky. One of the things we want to do with the institutional investor, and this is where our process is in terms of the value of the blockchain, is in syndication. Because as you mentioned, is antiquated. They do via spreadsheets. So we want to create more, we want to syndicate the invoices, the large invoices. We are institutional investors and creating secondary market as well on that front. So that's really what we have in our line of sights in the short, medium term as well.
Okay. And actually, just before we go, the FTX, that's not impacting you at all, or aside from the general market, obviously, but there's no fallout from you from that breakdown.
No, the FTX thing's crazy. I mean, that highlights exactly why I'm a little bit critical of centralized bodies, because sometimes they can be bad actors. And, Sam Bankman-Fried was running a very opaque business model. And one of the biggest things was that none of his transactions between Alameda and FTX could be scrutinized, because they were all done, off chain in a lot of respects. There were some done on chain that people found out about. But that's something, it's a great example of no transparency in a centralized system, that you can't see what's happening. And then it turns out they're taking customer funds and they're using them to prop up a hedge fund that's a related party. So it's a terrible thing. One comment I will kind of add on here is around what does need to happen in America to stop this from going on is, obviously I'm a DeFi advocate, but I'm not anti-regulation for centralized bodies. And one of the things is regulation for crypto and blockchain in general in America has been very murky. It's been very difficult to navigate. Brian Armstrong, the CEO of Coinbase, talks about this a lot. He says it's quite a challenge. He's like one of the only people working with regulators. As a result of murky regulation and difficult regulation bounds, founders go, well, I'm going to move this offshore because it's too hard to do business here. They move it to the Bahamas, in Sam's case, the Bahamas, where FTX is based. And then retail customers access those exchanges via VPNs, because most people are technology savvy and they go about doing that. And then the regulator has come out and said, we're going to, really lean into DeFi and punish DeFi and crypto. DeFi had nothing to do with this. This was very much a centralized exchange. What the regulator needs to do is actually stop forcing people offshore by making stronger and more clear regulations here that people can easily follow. And then that'll prompt people to go, oh, I will do business here. And retail customers will go to that exchange and work there. So I really think that's been a massive problem. And what we're doing at Crowdz, and I think it kind of helps us, is we're advocating for a bit of a mixed model, DeFi, CeFi. And we're saying, no, we want some transparency on these transactions between parties. If you look at an invoice financing deal, there's a supplier, there is a customer, who's the buyer, and there is a funder. And at the moment, there's no transparency between that relationship. It's very opaque. If we put some of the data on chain, it opens it up. Things can be seen. We put some of our credit underwriting, our surf score on chain. Once again, that can be seen by others. It's just everything becomes a lot easier to scrutinize and to be seen, which in turn you'd think would lead to more liquidity, but importantly lead to more people upholding a healthier system, just generally. And
you were saying earlier that you're going country by country. Mark, you were saying that in each country you're right, working with the local regulators, the rules, the laws, whatever. So it's a slow sort of ad spread. Fascinating.
They're all different each country. So
Yeah. Yeah,
some,
hard.
I feel a lot of countries are doing better than America though on the regulation front. They're coming in, they're trying, they're trying, you know, they're going, this is as best we can do, this is as clear as we can get. And founders are gravitating towards those regions, going, we'll work there because we're not scared, essentially.
Yeah, that's why I think I will advertise my country. Some would say because of tax, but I think the FINMA, which is this central body for regulation in Switzerland, is I think a bit clearer than other countries. So as opposed to take a stand that, you know, we don't want it because we don't know it, it's just like, you know, we treat it as, you know, as what it is an asset, is a security. And it means that if you trade this way, you know, you can, but it's not going to be different to, let's say, a centralized method. So I think that's why you have all of these companies moving, at least to have a headquarters in Switzerland. There is a tax element, I don't deny that, but there is also, you know, some clarity from the regulator.
Yeah. And so people want to find you. It's Crowdz with a Z.
.io.
.io. Okay, perfect. And what about the Avalon Marketplace? Is that also referenced on the Crowdz platform? So go to Crowdz and then
go to Crowdz and check everything out there. And you can probably find Mark and I on LinkedIn and wherever else on Google. You can see us.
Perfect. Well, thank you so much for your time today. It sounds amazing. I love disruption, and I'd quite like, because you're not, even though we're jokingly calling you an anarchist there, James, but you're actually disrupting, not in an anarchistic way, but in a very functional form way, saying, let's make this work.
Yeah.
So that's also nice to hear, because if you're going to either raise money or invest money, you want it to be safe.
Exactly. Mark often pokes fun of being anarchist. I'm very level-headed, strong advocate for DeFi, but also appreciate we need CeFi. It's, of course, you know, keeps the world going.
Perfect.
So,
thank you very much for your time. That was amazing. So Crowdz, Z or Z, depending where you're .io. Thank you very much, Mark and James.
Pleasure.
Thank you.
Bye.